Hello, this is Louis Llanes with Wealthnet Investments, and this is the market call of the week for August 9th, 2018. Today I want to talk a little bit about mistranslations. Sometimes mistranslations can cause more than just embarrassment. Back in the 1950s, there was chocolate companies that began to encourage couples in Japan to start celebrating Valentine's Day. But a mistranslation from one company made it seem like the idea was for women to give chocolates to men. This practice is continued to this day, with men doing the same for their partners on March 14th. Sometimes during earnings seasons, I feel like Wall Street mistranslates the rituals during Valentine's Day. They punish companies with strong earnings, they overreact to less than expected earnings, and they give too much credit to good earnings. So today what I want to talk about is how to interpret earnings, how to keep your sanity, and how to really try to profit from Wall Street mistakes during earnings season. At first, I'm going to go over some earnings that we had in our portfolio and give you some examples of extreme upside and downside movement that we saw. And then I'm going to talk a little bit about the market performance over the last trading days for our market call. And then I'm going to summarize a little bit about what the remedies are to dealing with earnings and actually making profits and managing risk in this environment. So Grubhub recently reported their earnings, and on July 25th, they reported their second quarter earnings, their GAAP earnings, and the consensus was actually positive. You can see here that the company actually beat earnings expectations by 20%. So the estimate was 41 cents, and they actually earned 50 cents. And on that day, we saw a very dramatic pop up in the stock price. So that was a good example of making money on a big earnings announcement. But there was a huge pop on that news when in actuality, what we actually saw there was positive, but it wasn't that positive. So we saw a really kind of an overreaction to the upside. IQVIA, same thing. On July 24th, they announced their earnings, and they only beat the street by 4.5 percentage points, but the stock went up a lot over that time frame. And I'm going to give you those numbers here in a little bit. But we saw over a couple of days the stock move up pretty dramatically, even though they earned only $1.29 versus $1.29 versus $1.23. We also had a couple of downside moves as well. Zillow reported 13 cents versus 10 cents. They actually beat the street, but the stock actually fell on that news. So it's not really necessarily related to whether you beat earnings or not. The market mood has a lot to do with how things are going to go. Another downside revision that we saw, or downside movement we saw, was in Hostess Brands. Hostess Brands reported 14 cents when the street was expecting 16 cents, and the stock went down pretty dramatically in one day, even though the valuation didn't really change that much. So Hostess Brands went down because Walmart decided to change their displays, so they didn't give Hostess Brands as much shelf space as they normally would have anticipated. So Wall Street punished the stock on a revision downward from a buy to a hold. If you kind of summarize what happened in our portfolio in terms of the large moves on earnings announcements this season so far, we actually had two big upside and two big downside. And the other earnings reports that we've had so far in our portfolio haven't really been that big of an impact. But I wanted to highlight just what can happen with earnings season and how you can mitigate it. If you look at the net result from these earnings reports, you can see Grubhub went up 23% on the news, and IQVIA went up 12% on the news. Zillow went down 16% on the news, and Hostess Brands went down 17% on the news. Now, our target allocation in our portfolios is around 2% for these stocks. So if you look at the actual impact to the portfolio, it was actually really averaged out to be close to zero. In fact, it was a slight positive, even though you had these big dramatic moves. So sometimes investors can get sidetracked. If you have smart position sizing and if you have diversification across sectors, then you really can reduce the impact of these big one-time moves. So if you look at this, Grubhub is a consumer discretionary company, IQVIA is a healthcare industry, Zillow is in the real estate industry, and Hostess Brands is a consumer staple. So they have different drivers of earnings, different things that drive their profits and losses. So even though Wall Street can make these big dramatic moves, the net impact can be minimal. And that's really what you're trying to shoot for when you're managing a portfolio, is you're trying to kind of eliminate the idiosyncratic risk or the company-specific risk that you could see in one-day move, and actually have a diversified portfolio. So now I want to switch over to the market mood, because a lot of times what we need to understand is that how the market reacts to earnings has to do with the mood at the time, whether or not the market participants are risk averse or whether or not they're taking on risk. So those earnings that we saw earlier on, the markets were actually willing to take on more risk. And then we saw a little bit of a risk decline or risk aversion. And then we saw those other stocks not react as fondly. Now, and a lot of times what can happen is these stocks are actually moving against what you would normally expect. For example, Zillow beating the street by 32%, but yet it goes down in price. This chart here shows where I have it highlighted with the yellow is the last 5 trading days returns. So we can look here that the mid-cap stocks, the mid-cap 400 were up 1.6%, S&P 500 up 1.5%, and small caps up 1.3%. So actually we're starting to see the mid and large companies start to outperform the small companies. Small companies have been on a tear. If you've been watching the market calls, we've talked about how that could slow down a little bit. We still see the international markets, the emerging markets, down 45 basis points, and as the MSCI EAFE index also sold off. So really we're seeing that divergence between the two markets continue. I know some value players are starting to play the opposite side of that, as there's some companies that are presenting opportunities there. If you break it down into the sectors, you could see that we had a resilient kind of return to the technology and consumer discretionary sectors. You could see that the technology area was up 2.84%, consumer discretionary is up 2.9%, and the financials also came back to life, 1.86%. The overall stock market was up 1.62% in the United States, so you could see that they led by a pretty decent margin. We saw energy has been lagging, and so has real estate, materials, and industrials, and the staples. Healthcare has been slightly underperforming the last 5 trading days as well. In the fixed income markets, the high yield bonds have started to move higher again, so that kind of shows risk on, and that really kind of coincides with the increase in the technology sector that we saw. But one thing to note is we also saw that the long bond, the Vanguard long-term bond, BLV, is up 23 basis points. So that's a very interesting development, that we have taken a position in BLV really as an offset for a slowdown in the economy. And the total bond market actually was down 39 basis points. In the commodity area, we saw the base metals come back to life. The base metals have been under pressure, as you can see with these red cells here, minus 18 or minus 11, minus 11, minus 4. So longer term, we've seen a decline, a pretty significant decline in these base metals, and they're kind of bouncing off of those in a downtrend. Same thing with the overall commodity index in general. We saw overall commodities are up, but we saw kind of some recent declines, and we're moving back higher. Agriculture has also been under pressure. We saw a reversal of that. Energy in general has been the kind of the leader in the commodity area, driven by oil, and that had a slight rise up, although the stocks themselves did not participate in that rally. As far as the currencies go, the US dollar continues to be strong, and as you can see, that has been leading the way. The Japanese yen has been also a safe haven, has kind of been relatively strong in the last week. Australian dollar as well, up 47 basis points. So we saw the British pound sterling drop 1.8%, pretty significant drop. It's been weak with all the Brexit concerns. The euro has also been weak and under pressure. Swiss franc has been under pressure as well. Canadian dollar also under pressure. So I want to circle back now. That's kind of what's happened in the last 5 trading days in the market. I want to circle back a little bit to this earnings discussion and how misinterpretations can make a big difference. And I want to talk about a few different things. First, I want to talk about what we should remember during the earnings season. We can have obviously sudden moves, both up and down, and the direction depends on the appetite for risk. How these earnings are interpreted is not just company specific, it's also market specific. So that's one thing to keep in mind. So beating earnings per share can lead to both sharp rises and falls. And because of that, we can actually profit from that if we have a longer term position, if we have a longer term view about what we're doing. The real remedy is threefold based on our process and how to deal with these uncertain earnings reports and the volatility that we see around earnings. The first is smart position sizing. And what I mean by that is understanding that we're going to expect the unexpected and that we are going to leave our positions some room so during these earnings reports so we don't put too much money on. We want to have a smaller position size, especially for the companies that have more volatility in their earnings. So the more stable the company is, the higher the quality of that company, the larger the position size we take, and also the larger the expected return, the larger the position size we will take. However, we also look at the volatility of the instrument. So the higher the volatility of the instrument and the higher the risk of the earnings, the smaller the position size that we're going to take. So that's a big part of how we are able to have these big swings in our stocks, but yet our portfolios don't have these big swings. And the key is also to have that diversification. Because we have the diversification in sectors that are non-correlated and even in asset classes sometimes that are non-correlated, that gives us a smoother ride. And the thing that we want to do is we want to add value and seek to add value from a longer term process, a process that is repeatable, that we can continue to do over and over again by seeking valuation, looking at the price right now compared to its intrinsic value based on a reasonable expectation of earnings and cash flows. Having that in mind really helps you over the long run. And the second thing is that diversification factor for the short-term swings, because you can have a short-term swing, and a lot of times you do have this where Wall Street will literally make a mistake. There'll be a downgrade and there'll be a short-term liquidity crunch, and you'll see sudden moves in these stocks. They'll move 10, 15% in a single day. And a lot of times, if you have your fundamentals right, that could actually be an opportunity to add to these stocks. Just because you have a sudden move that's down doesn't mean the stock is not a buy anymore. In fact, there's some signs to, if you have your fundamentals right, it's actually the opposite. So the key is to focus on that long-term process. Unless you're a short-term trader, now that's not our business. We're in the longer-term investment. We typically have a 1 year or more time horizon. We have a part of our portfolio that is shorter term, where we're looking at 63 trading day or greater, more like a quarter. So, but that's a smaller degree of what we do. So the other part of this is the key psychology. I should say the key psychological ways we like to think. And first is that Wall Street upgrades and downgrades lead to knee-jerk reactions that you can take advantage of. That's kind of the psychology we want to have. If you think about it, the valuation of a company's business doesn't change as dramatically as you see in the short-term price moves based on information from one earnings report. You can't really, it's hard to justify a 15% move in a stock's value many times. Now, sometimes there is some news that's so significant that it should move that much, and even more so. But a lot of times, if you've got your fundamentals right, the stock should not move that much in a single day based on its intrinsic value. So it's best to let the stock settle down, analyze the facts, don't trade emotionally, and expect the unexpected. All right, so this is Louis Llanes with Wealthnet Investments signing off. Happy trading, everybody, and we'll talk to you next week. Our market calls are not investment advice. It is information you can incorporate into your own investment strategy. And as always, do your own homework, assess the risks, and invest in light of your own personal goals.